What's up, Empire Builders? Welcome to another Weekend Reads. This is episode 3. We're going to catch you up on the week of emails sent this week and just kind of talk macro recap. Now, I don't know how you guys are liking these. They seem to get lower views than the rest of our videos, but if you like this, then give us some love. Give us a quick comment, give us a like, share this around with your friends, share it on social media, whatever you got for us. But help us with some ammunition here to get this thing in front of more people if you enjoy it. So you obviously get the benefit of the daily emails, which are free, all right? And you get those right to your inbox if you sign up with just put your email address. Okay, this is not done through me. This is done through Substack, which is a third-party service. So yeah, all you got to do is give your email address, but you don't even have to do that. You can actually view all of our emails for free if you just click no thanks, and then it shows you the full stack going all the way back to April, which is now over 80 emails. So it's a lot. There's a lot to catch up on. So last week was pretty eventful week, actually. Went back and did some final edits to the Global Reset report that I put out. It's now up to almost 60 pages, bringing up to speed all the yield curve inversions and everything that's been happening there, and then some more of the pieces that I'm starting to see between this division that's happening between the Fed and the White House, which I've spoken many times about, I think is a good thing. The short term for that might not be good, and people will be scared and people will be pushed out of their comfort zone, but I think in the long run that is the best thing for the people, because the Fed is not the government. They're not owned by the government. They don't care about the government outside of the realm of what they need to do and the relationship they need to have. But, that isn't in, the Federal Reserve is not a company, organization, structure that is out for our best interests, okay? They're not thinking of the little guy like us, okay, at all. So anyways, I covered this in the 17 trillion debt video that dropped on Monday, so I covered a lot of what's in here. We'll just quickly recap. 17 trillion negative yielding debt crossed over this week. It was 16 trillion at the time of this tweet. And Bank of America Merrill Lynch, basically they said that there's been 10 2-year to 10-year inversions. That means the 2-year is paying more than the 10-year, so it makes more sense to hold the 2-year. And the reason why this matters so much against the 10 years, not only did we have back in June the flippening of the 3-month over the 10-year, but now we got the 2-year over the 10-year. That matters because a lot of people, a lot of companies and mortgage rates and stuff are benchmarked and stapled off the 10-year. So if that starts to fall, it can really throw things off. And that makes economic conditions worse, even if they're not, okay? And as I've always said, public perception is a pretty big indicator and a pretty big driver of what actually happens in the markets. So that obviously is important from a facade standpoint. So going back to 1956, they got 10 of these bad boys, okay? And 6 of them, within 3 months, the S&P, 6 times within the first 3 months, there was a topping of the S&P 500. 1959, 56, 59, 65, 73, 80, and 2000. Okay, the other 4 times, it took somewhere between 11 to 22 months for the S&P to top. Needless to say, you should probably have a long. There was a 600-point drop this last week. Where's the long positions? Where's everyone rallying, talking about going long? You see how funny that is? Public perception, like I said, the candles that you see on a chart are people's emotions. That's people. People are price. And so how they're feeling, what they're thinking, you see that reflected in any risk asset class. You see that reflected in the candles themselves, okay? And I don't care how much you want to talk about fundamentals, so on and so forth. Fundamentals, technicals, they do drive the price because they drive the opinion. They drive the behavior almost and how people are feeling about it. All right, so there you go. There's that. What else do I have in here? Debt ceiling is basically removed. We went up 1 trillion in 1 year. They were estimating it would take 2 years to go up another 1 trillion. In debt, it took 1 year. So again, just take that for data's sake. Okay, let's jump right into Tuesday now. Rolling into it. And I finally covered the eurozone in more detail. Why have I avoided that? I don't know. I talked about this a little bit. I think that I was feeling a little bit behind with what's gone on. I think that part of me thought, well, they've been continually struggling since 2007. We had 2012 Cyprus incident. We've had Plenty of situations happen in Italy ever since. Currently, we have 41 weeks of yellow vest movements, yet Macron showed up to the G7 just over this weekend and has somehow brought the president of Iran and is going to talk about climate change. Well, you can't even get your own people to rally together. So what makes any of us believe that you can, rally heads of country together? He's kind of one of those guys that comes on TV and speaks a bunch of worthless platitudes and then nothing ever changes. And if he actually understood people, which he clearly doesn't, he would understand why his people are protesting and be able to work out a solution. But he doesn't. And you notice the difference between how he approaches things and how, I can't remember his first name, but Boris, that is now in charge of the UK, is running things. Pretty different, okay? Speaking of Boris, he's given a deadline of October 2019. I believe it's the 21st or the 31st of 2019 for a decision on Brexit. How long has Brexit been being talked about? The whole thing about Europe and the UK Parliament and European Parliament is, to me, it's like a big joke. It's like a bunch of people meet up, they play dress up, they meet up, tons of cameras around, and they get to stand up and speak, and then nothing ever seems to change. How long have they had to work on a Brexit deal? How long has Europe had to try to fix this problem? And it goes all the way to real estate and banking and retail. And they already know that such a strong amount of their GDP is based on exports. Where is that growth? I guess I just don't get it. Maybe it frustrates me, so I don't really talk about it. I don't know. I should probably explore that for myself. But needless to say, I finally give a nice, big, fat eurozone breakdown. Eurozone banks could break below 2008 lows. I believe they have since I posted this. We're talking below 2008 financial crisis numbers and right in line with Greek debt crisis numbers, okay, which is very, very bad. We're in negative yielding territory. Where are they? Oh, I didn't put that in here. Okay, that must have been in the report. We're in negative yielding territory for a lot of European countries. Let me actually pull that up. Hold on. Okay, here we go. Sovereign yields, negative for most countries. Yeah, a lot of these are in Europe. Germany doing really bad right now. And the United States is one of the only positive. Okay? Yet, the United States is positive, but what are you seeing on the news? You notice how some news networks are playing almost this storyline that the recession is coming. And I like that from the angle that it's teaching average Joe about negative yielding bonds and outstanding debts and things that he might have been ignoring and pulling the wool over his own eyes on. I like the fact that that's now being brought up and he can't ignore that anymore. I don't like the fact that it creates unnecessary panic, and I don't like the fact that for the most part it's not true. And we'll get into that in just a couple minutes in the email that I sent out Thursday or Friday. Okay, so anyways, there's that. Okay, so if you didn't know, most European countries have strong exports. Well, that's where a lot of their GDP comes from. Case in point, right here. EU, Europe, okay? Less than China and the United States. And quarter one, quarter two so far has been pretty bad GDP, okay? So they're hurting. And they are partially saying, we don't have a solution, and partially saying, well, the trade war between US and China is to blame. And that's very convenient to me because once again, we have politicians who have no accountability. Nobody tries to hold them accountable. Everyone just assumes that they can't be held accountable. Once again, diverting focus and saying it's this guy's fault over here. Again, going back to France, where are we at with the yellow vest movement? Why is there no media coverage still after 41 fucking weeks? We get minuscule media coverage. Look at the violence in Sweden. Look at the violence happening in London, UK. It's got to stop. Okay? And that's why, to me, a lot of those countries, it's null and void. Like, what's coming out of your mouth, I don't believe you, I don't trust you, because I'm seeing what's happening on the ground. Open immigration policy and what that's causing. I'm seeing the fact that there's no Brexit deal, the fact that we still have this issue going on with trying to force all these European countries to work under one system. Obviously, that's not working. So why don't we just come up with something new? It's like the guy who just doesn't want to change, right? And maybe he's fat or something or broke, and you're trying to tell him, like, this is why you're fat, this is why you're broke. He's, no, I think it's this over here. I think I need to build a rocket ship to Mars and just go live there because the ozone layer, or the density of my body here, or how like super complex, something super complex. And a lot of times in life, I'm sure you've noticed this, but the simple things usually work. Okay, here's what I was talking about. This was Wednesday's email. UCB balance sheet is looking worse and worse. Okay, you don't want it to actually be ascending like this. That's the balance sheet. You want stocks to be going up, not balance sheets. So this is the ECB, the European Central Bank. And so there's a recession dashboard by, you're going to love this one because I pronounce this perfectly wrong every time, Credit Suisse or SUS. And they have a recession dashboard. Just take a look at this image for a second. Can we blow this up? No, we can't. All right, forget it. But it's basically taking into effect a bunch of different indicators. And it's looking at every single recession since 1973 and giving you the performance. Look at where we are presently. Okay, recessionary, expansion, 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 neutral, neutral. And compare that to like any other actual recession we've actually had. Now, and you tell me, does this look strong or poor right now? Do we look good or not so good? Okay, so again, that's why like you got to really watch where you're getting your data. You got to really pay attention to what people's narratives are and what people's bias are. Because right now, like I said, there seems to be this push that like everything's bad, and it's like this attempt to pin it on Trump. There's a lot of stuff that they're trying to pin on Trump. But let's be clear here. Fiat currency itself is a scam. I've always said that. So let's break this down. The value exchange here. You have something I need, or I have something you need, vice versa, whatever. And we come together and we say, okay, I want this and I want this. Great. And that right there, whether it's knowledge, information, deer, cows. Why did I just say deer? I don't know. Cows, horses, food, meat, grain, whatever, right? We come together, we work out a deal. That is called a value exchange. Now, because that got so hard to do, we came up with this piece of paper that acted as a note between us to kind of staple down the value temporarily between us, just so we could exchange it, so that there's not all this paper trail and all this confusion going on. That's fiat. That was the birth of fiat. Now, what's gone wrong with people is they think that's the value. So I have to do whatever I can to get the dollars because the dollars are what's valuable. Wrong. And China's by far the best example of this. They've been able to take fiat dollars and spread them all over the globe and get something of actual value in return, which is assets. So you want to take those dollars and turn them into assets. That's luxury cars, art, land, real estate, gold, and metals. Possibly Bitcoin. It's still a risky asset class, but you could try. Stock market, anything that is an actual asset. All right? Because if you look at your purchasing power, it's not going up. I love this chart because of how dramatic it is. And you see it only goes up to 2013, so it's dated. Okay? All right, next. Hedge funds, not doing good. Over the last 3 years, more hedge funds are shutting down than opening. So far in 2019, they've bled 50% more than in 2018. That is, in numbers, $55.9 billion. And across all the hedge funds so far in 2019, and we're only into quarter three. All right, and that's up from $37.2 billion from last year. Quite a bit more. All right, and the inflows aren't good. It's mostly flowing out, and that's not good. So inflow means people coming in to the fund. Flowing out means leaving the fund. All right, so essentially, I think this is because it's not because hedge funds charge a lot. It's because the trust is down with hedge funds. There's a lot of them, and they've had pretty good free reign even after 2009 crisis. I mean, we saw a dip, but then it just kind of popped right back up, business as usual, going after these unicorn IPOs. There's over 300 unicorn IPOs. Tons of them are on the chopping block to go public this year. And I hate to say it, but the average investor just doesn't really do that well on those with those returns. They're more of a get rich quick pump and dump for round one and early seed investors versus hedge funds that come in and usually the position that they get. And the S&P right now is through 2019, and it started in the middle to tail end of 2018. What's driving most of the stock market action you see is share buybacks. So an incentivization for the companies to be buying back shares from the public, that is not bullish. That is not bullish. And the other side of it that's really bad right now that I think sucks because a lot of people are missing out on opportunity is that how many people actually bought last week when the S&P dumped? And you're all waiting. It's Sunday right now. We're all waiting for the markets to open, pre-markets to open. So how many people are actually buying right now? I guarantee you it's not a lot. And I learned this through trading Bitcoin because if you've been following along, I had no previous experience of how really markets worked and economics and so on and so forth before Bitcoin before I started trading it. But it's the same thing with Bitcoin. Bitcoin starts going down, and you have people calling for lower bottoms, don't you? You don't have a lot of people looking for positions to enter. Oh, well, it went down to 7,000, so it's going to go down to 5. Once it goes down to 5, it's going to go down to 3. Fuck, before you know it, Bitcoin's going to be 0. Why not be buying, right? You just don't see that. And you don't see that with the traditional markets either. So right now you have a lot of people waiting on the sidelines, and unfortunately they will miss out on this next run-up that occurs because we will hit new all-time highs. Even if these recession indicators are correct, which again, if I'm going unbiased, unemotional, just looking at the data, then I should be in these markets for at least the next 2 months. Agreed? All right, so I'm going to drive that point home. If you've been watching the videos, I've said it now like 6 times, I feel like. But it's only because I want to really call out the bias and get you looking at this differently. So at the point of this email, I said, hey, look, G7's going to happen. That's just happening. Not a lot of news has broken yet. I might be having to update some things and put out another video. But as of right now on Sunday, 12 o'clock, not a lot of information out yet because it hasn't concluded. And then the Jackson Hole meeting did conclude. I feel like that deserves its own email, which will happen this week because hint, hint, they once again talked about digital currencies and how the US isn't going to be the reserve currency forever. And I think that's very curious, and it fits in alignment with everything we've been covering since last year when I first kind of started stumbling on this dual currency bail-in that the IMF has planned and the bankers have planned. Thursday or Friday, can't remember which, 22nd. Come on, Jay, get it together. Thursday. Shot this audio. I do these from time to time. They usually do really, really well. We get about a 50% download rate, which is great. And this was about breaking out of comfort zones. All right, so give a listen to that. And then Friday, we wrapped up with, once again, coming back around to GDP. And this is the topic that I also wanted to talk about for about a week. And it's the fact that when you hear about GDP, specifically consumer spending, that's this one right here, okay? Private consumption. You hear about retail and how media and how a lot of talking heads try and spin this is because all these things are closing down equals bad news. Not necessarily. You need unbiased data because in the numbers, we actually have online data as well. Which if you look at online data, it's doing just fine. It's actually growing leaps and bounds. And to seasonally adjust that, so far in Q2, we've soared up 13.3%, which is $146 billion in online sales. E-commerce is online. E-commerce is such a dumb name. It's just old school, I guess. And I talk about this quite often. A lot of people making a lot of money with Shopify, Teespring stores, drop shipping, FBA, Amazon, all that good stuff, okay? And there's good reason. It's not just a bunch of people all of a sudden have ads up in your Instagram and Facebook feeds talking about this stuff. They're not lying. Now, I don't know how they actually made that money, but I'm just saying like there's a lot of money to be made with e-commerce still. Here's your top 10. Home Depot has brick and mortar still. Apple has brick and mortar. Walmart has brick and mortar. eBay does not. Amazon does not. Well, they have brick and mortar, but they don't have physical locations. There we go. But a lot of these have physical locations and online. And if you look at this interesting data, we have e-commerce going up and retail going down. And that's okay. That's completely okay because it proves that we are at a pivot point. We are setting up a completely brand new foundation. At 20 years from now, we'll be like, wow, we actually used to like walk into a store and do that, right? It's going to be like that. It already kind of is, but it's just escalating more quickly now. 2008 online sales broke records. It was obnoxious, the Christmas sales that happen online, especially through Amazon. New records set. And I think that's really important information. And I think that's mostly skewed on purpose in this GDP data to get you to feel like the economy's in this shitty position and doom and gloom. It's not. It's not. Now there are a lot of retail centers that will go down. Malls will go down. Malls will be repurposed. A lot of those are getting used as fulfillment centers because their location to freeways and access on and off those freeways is usually really good, and they're on the outskirts of suburban areas, which work perfect for fulfillment centers. So those will continue to get recycled, and some will go empty. A lot of them will. Some of them I'm seeing starting to get recycled into storage units. Some of them fulfillment centers for Amazon and other big places like that. But this will just continue to get recycled, and some of it will start to just go empty. But This is the next iteration of the big next jump that we're making. And that needs to be brought into the equation with GDP. Most people don't know what actually makes up GDP, so I'm once again stating that so that everybody's up to speed. And I want you to know these things because this is basic information that if you went down the street, asked 10 people what is GDP, they wouldn't actually be able to tell you what the model is comprised of, would they? So there you go. All right, that's Friday. So yeah, be on the lookout this week. We got to go through the Jackson Hole Central Bank meeting summit thing that they did. Obviously, we're gonna have some G7 stuff to talk about, but it's gonna be a pretty exciting week. We should see some action in the S&P this week as well, obviously, because everyone's kind of waiting around to see what it does this week. I don't know if there'll be much new. I don't know if there'll be any new revelations with the China trade tariff war, because last week the tariffs were put back on and that's what caused the Dow plunge to begin with. But yeah, we'll kind of recap some of that, I think, early in this week, and then get into whatever reveals itself and starts to really roll out for the rest of the week. But that's all I got for you. Thank you so much for tuning in. If you like this video or just want to support us, like it, comment below if you got something to say, share this with a friend. If you're brand new to the channel, subscribe, hit the bell notification, be on the lookout, more videos dropping soon. Bye.